Good evening, everyone, and welcome to Inspire and Inform episode number 11. It's so fantastic to be able to spend some time with you all each week at Wednesday, 6 p.m. to share some of the insights, some of the things we're seeing going on in the property market, trying to add value in any way that we possibly can to serve you and to help you along your journey towards building a better future for yourself. So we've been taking a little bit of feedback this week and trialing out a new format for you. So I'm going to be doing tonight's presentation alone, just so we can focus in on the content that I have to speak about tonight, which is all about diversification. And we're going to try and make these episodes a little bit shorter and sweeter and a little bit easier for you to digest and really take on board some of the lessons and the insights that we're providing during these sessions towards becoming a better investor and a better future for yourself. So tonight, as we said, we're going to be talking about diversification. And it's an interesting topic to really delve into. Tonight, we're not going to have any spreadsheets. We're going to be talking on a fairly high level. And of course, just as you're all aware, we don't really have a good understanding or have any understanding, to be honest with you, about your personal situation. So the information I want to share with you all tonight is general in nature. It's not classified, or it's not indicated towards your personal circumstances, so therefore it cannot constitute advice. It's impossible to give advice across these forums. So, on to diversification. What is diversification? It's for those of you who have spent any time thinking about, investments, it's probably a term that you've heard fairly commonly used. And the reason why many advisors, whether it be in property, shares, or any other type of asset class, are generally advocates of diversification is that regardless of which asset class that you're talking about, typically there's many different options within that asset class for you to invest in. And typically these markets tend to move at different directions at different times through different cycles. So one of the reasons as an investor of any asset class, and this applies to property, shares, or every asset class that we like to speak about diversification, is that we want some exposure to those different types of markets when some are going through a growth phase, some of them potentially going through a declining phase. So overall, as an investor, we tend to get a little bit more security and tend to be able to mitigate our risk a little bit better when we adopt a diversification strategy. But on the flip side to that, and this is an important thing for us to consider, is that it's really, really difficult for us or any individual to be across all different types of markets at all different times. And there's a couple of reasons for this. One reason is that our asset base, or how much that we have to invest, may not be able to allow us to gain exposure across all different types of asset classes in different markets at the same time. For example, when we're talking about property, we're talking about quite a significant investment that we're making with each asset purchase, a couple of $100,000 up to $1 million and more. It's very difficult for most of us to have enough money to diversify across into shares, into other different asset classes at the same time. And the other side of the coin is that it's really difficult for us to be on top of everything that is going on across all these different types of asset classes, across all these different markets, all at the same time. So the question remains, should we specialize in one particular asset class and make ourselves an expert in that particular asset class? Well, the interesting thing, and just sharing from my personal story, is that I've chosen property as the asset class that I want to specialize in. And I was conflicted when I was beginning out in my journey, because I believed in this diversification, because I wanted to use it as a tool to help mitigate some of my risk and make me feel a little bit more confident in the actions that I was taking. So what I learned during this stage was that it is possible to diversify within each asset class. And obviously here at Inspire Realty, we focus on property as our asset class. So I wanted to share with you tonight some of the ways and some of the reasons why you might, as you're building out a portfolio, you might consider diversification within property as an asset class. And there's a couple of different ways in which you can do that, and we're going to dive into that. So what about diversification when it comes to asset type? So there's a number of different types of properties that you can add within your portfolio. So right from residential to commercial to industrial, and the different types, short-term accommodation, there's a number of different types. But even within residential property, and that's what we focus here on at Inspire, and that's what I'm going to focus on tonight. There is several different types of assets that you can buy within residential property. You can buy houses, you can buy apartments, you can buy townhouses, as just an example of those. And what I wanted to do was to actually bring in a little bit of data to be able to sort of justify or justify the case of how, or some of the differences between these different types of assets, being apartments and houses in this case, and some of the reasons why you would want to diversify and have both in your portfolio. So it's a common question that we get asked: should I buy a house or should I buy an apartment? And typically what I'm about to share with you is part of the answer that I would give to that question. So as investors, one of the key ways in which we build our wealth is through capital growth, or the appreciating value of the property over time. And when I used Melbourne as an example, and I looked over the last 20 years history of Melbourne, I noticed something interesting when I compared the capital growth of houses in Melbourne versus the capital growth of apartments. And as you can see, they've both grown over the last 20 years at 8% and 7% in terms of capital growth. So typically what you see, and there's obviously exceptions to every rule, is that houses tend to grow faster in value over the long term compared to apartments. Now, why is that? Well, when it comes to property, there's two sides to the coin. One is the land, which tends to be the appreciating value. And obviously you own less land when it comes to apartments, potentially higher value land, because you're got a small portion of some very valuable real estate. But houses on average have a higher value of land, whereas the depreciating side of your property purchase is the actual apartment or the actual house. So the ratio of land to asset value is higher when it comes to houses. And that's typically, and again, there's always exceptions to the rule, why we see houses have a higher appreciation rate or capital growth rate when you compare to apartments. So if you were to just take that side of the coin, you would say, well, I'm only going to go out and buy houses, and I'm never going to buy an apartment. But you really need to consider, I guess, the other side of the coin when it comes to property investment, and that is the cash flow side of it. And what you can see on the right-hand side of the screen is you can see typically, and just taking Melbourne as an example here to provide you with some data, houses have a lower yield or rental return when it comes compared to apartments. And so what that means for you as an investor is that it typically costs you more to hold on to a house when it compares to an apartment. So at different stages across your portfolio, you're going to be targeting capital growth, but you also need to be very mindful of the cash flow that's required in order to be able to hold on to that investment for long enough to allow the capital growth to happen. So that's why in my own portfolio, I have a mixture of both houses and apartments, which serve a different focus. Now, they both go up in value, but some faster than others, but serve a different purpose within my portfolio. And that's why I diversify in the different types of assets that I have within my property portfolio. So that's just one example of how we diversify within property in terms of our asset type. Now, if you have any questions about this, if you want to delve a little bit deeper into whether or not potentially a house, an apartment is right for you, very happy to have a chat with you. Feel free to reach out to us at inspirerealty.com or drop us a comment on the post that you're watching this presentation, and be more than happy to help. Going on to the second type of diversification is diversification in location. Now, one of the things that I learned very early on in my property investment journey is that you hear a lot of commentators talking about what's going on in the property market. And still today, I get so many questions from friends, family, colleagues, and they say, Andrew, what's happening in the property market? My answer to that question is always going to be, which property market are you talking about? And just to give an example, I pulled up some data around the median house values across the different states in Australia. And just to sort of highlight the point that each market, just when you're looking at a state level, and then we can drill down at some stage in the future to a suburb level even, and we can see that they perform differently at different times. So to give you an example of what we're talking about here, I'd probably like to draw, and what I might do is I might actually bring up this screen a little bit bigger so you can see the chart a little bit better. So we can see, I want to focus on two states here. I want to focus on Sydney and I want to focus on Brisbane. So what you can see is Sydney here through this period was relatively flat. Yes, it moved up and down, but relatively flat during this period here. Just adjusting the screen. That's, sorry. That period there's 2003 through, that's about 2003. That's through about 2011. And then you can see from about 2011 through to about 2017-18, Sydney's had quite a big boom. Melbourne tends to follow. Our two biggest states tend to move very closely together, being Sydney and Melbourne. But if you can focus in on the yellow section here, which is Brisbane, we can see through 2011 through to 2019 here, when Sydney and Melbourne were going through quite a big boom, Brisbane was actually quite flat during that period. And if you go backwards a little bit from about 2003 through to 2007, when Sydney was flat, you can see Brisbane had quite a big uptake there. So the point I'm trying to really drill down to here is, for different reasons, different markets move in different cycles. And you can probably pick the only other capital city here that actually surpassed Sydney when it comes to median prices is this black line here, which is Perth. And that's obviously on the back of the mining boom. So different states move at different times. And this is why, as you're constructing a portfolio, you would look to acquire different assets in different states. And that's really a mindset shift and an evolution or a growth that you need to go through as a property investor. A lot of people, when they're starting out their property investment journey, they're very much looking and focused on the areas that they know, that they feel comfortable with, you know, close to where they live or where they work, because to them, it feels a little bit safer. They can look, touch, and feel. If I'm honest with you, I haven't seen several of the properties that I own within my own portfolio. But it took a while for me to feel comfortable with this. It's very intangible. Just this week, I was commenting with my dad, and we were talking about the restrictions that are in place at the moment through COVID-19. And throughout COVID-19, I actually settled a property in Queensland. And he said, look, these people, they're just sort of saying, hey, give us your money, but you're not allowed into the state to come and have a look at it. Doesn't matter if you're investing $1 million up here, not allowed to see it. So it was the point I'm trying to get at is there was a little bit of a shift in mindset that I had to do in order to be able to feel comfortable to make decisions and diversify my assets across different markets, so that when Brisbane goes through its next cycle, I can actually be on the back of that. But I also do own property in Sydney and Melbourne, and it's each of those will move at a different time. So that's what I wanted to share there. The other variable as a property investor is, I think that diversifying out, and this is what I've done in my own portfolio. Another consideration is land tax. As property investors, unfortunately, despite popular opinion around the negative gearing side, we have to pay a lot of taxes to be able to hold on to our properties. And one of those taxes is land tax, but interestingly, land tax is a state-based tax. So it's based on the amount of land that you own within that particular state. So one of the strategies that I've used as I've built out my own portfolio is to diversify in the different states that I own property, and thus minimizing the amount of land tax that I need to pay. And just going on, again, this is design. This is the new style of Inspire and Inform. It's designed to be a little bit faster and a little bit more digestible for you. So if you have any questions around diversification, how it might look for you, just want to learn a little bit more, very happy to spend some time with you, have a chat, get to know each other. Please visit us at inspirerealty.com, or feel free to comment on the post that you're watching on. We'd love to hear from you all. So the key takeaways I really wanted everyone to take away from tonight. Firstly, as kids scream in the background, I hope you didn't hear that. Firstly, you can diversify within an asset class. Diversification doesn't need to mean that you own a business, some shares, a property, etc. You can also diversify in both the type of asset that you're purchasing. In the case of property, a house, a townhouse, apartment, they all have pros and cons. And you can also diversify within the location that you're purchasing your properties. It can be used as a way to mitigate risk. And again, that comes from different types of assets. So, houses, apartments, townhouses, and locations, all operating for different reasons at different times in a different cycle. And by having exposure to these different types of assets, you can help to mitigate your risk overall. Market cycles are always going to happen, and we really need to plan for them. So as an investor, for example, if you'd bought property in Sydney in 2012-13 and still hold it today, you've probably done pretty well for yourself if you recall back to the Sydney boom. But moving forward, how confident would you feel? And that diversification, having exposure to assets all across the country, is really going to help you to ride out the different cycles, and as well as maintaining your position. For example, if you were to believe that Brisbane might play some catch up to Sydney, even if your Sydney asset that you're holding, it'll give you some confidence to hold on to that for the next time that Sydney experiences an increase. And the diversification decisions are going to be based that you make. You can't diversify from day one. When you were starting out your property investment journey, you start out with one asset. So it needs to be based on your individual circumstances, and the right decision is not going to be the same decision for the next person. It really needs to be based on your own circumstances, what you're targeting, what you really need to gain out of this purchase that you're making? Is it cash flow? Is it growth? Is it, have you got 3 properties in Sydney and you need some exposure to different markets? It's going to be very much based on your own individual circumstances. And this is where I really get my kicks out of spending time with you all on Inspire, Inform, and more so spending time sitting down, getting to know you to help guide and mentor you through these decisions based on my own personal experience as well as my professional experience to really help you create and feel comfortable to take action. Because when it comes to property investment, as we know, it's a very big decision and it's going to have an impact on your future. And that's not something that I like to take lightly. And that's personally not a journey that I would like to make on my own. So if it's something that you are considering, we'd love to have a chat around diversification or anything else that's really concerning you, holding you back, keeping you up at night. We'd love to add value, have a chat, visit us at inspirerealty.com or comment on the post there. So really happy. Again, I'd love some feedback on the shorter version of Inspire Realty. Sometimes I know I get a little bit carried away. I've got a lot that I want to share and I just really want to add value in any way that I can. So we're trialing the shorter version. Love to hear your feedback. Please put a comment on the post. And really looking forward to seeing you all next week, where I think we're having another one of our strategists come on board to share their story. Got some really good feedback from Mel a couple of weeks ago sharing her story, and would like to make it relevant rather than just sticking with the theoretical side. Love to share some more personal stories and show you some different faces from Inspire Realty to really continue and share their lessons that they've learned. So really looking forward to listening to that next week. And that's all from me tonight, nice and short and sweet. So thank you very much, everyone, for listening, and see you guys all next week. Bye for now.